Let us see the next question. A project requiring an investment of 10 lakhs amount of investment and yields profit after taxes and depreciation, which is as follows. So in simple term, the profit information is given to us starting from the first year to fifth year, and the total profit is provided to us as 4,60,000. Yes, all of you have read correctly. This time the information is given to us for the profit and not cash flows. Suppose further at the end of the fifth year, the plant and machinery of the project can be sold for rupees 80,000. So scrap value of the machinery is provided to us at the end of the fifth year. It is an amount of 80,000. You are required to determine ARR, that is average rate of return, or it is given a name as accounting rate of return. That is what we are required to calculate. Everybody go through the question please, then we will discuss how to make the calculation of answer. Let us have understanding that's how to make the calculation of ARR. Dear students, for the purpose of ARR calculation, the very first thing that you are required to do is you are required to make the calculation of the average profit. As far as average profit is concerned, it can be calculated very simple, easily. It is the total profit divided by number of years, that is N. What is the total profit? It is 4,60,000 divided by 5. That is the way we compute the annual profit. That is an amount of rupees 92,000. So the very first working note that you need to prepare is calculation of the average profit after taxes. Once average profit is calculated, then you will make the calculation of ARR. As far as the ARR working is concerned, it can be calculated by one of the two methods. One is either you can use the initial investment for the purpose of calculation of answer, or otherwise you can use the average investment. As far as the initial investment is concerned, it is provided to us in the example an amount of 10 lakhs. That is the way the initial investment is calculated. And as far as the average investment is concerned, it is initial investment plus scrap value of the machinery divided by 2. So it is 10 lakhs plus 80,000 divided by 2. So the average investment comes to 5,40,000. This is the way we make the computation of the average investment. Now when you make the computation of the ARR using the initial investment, then in that case friends, it is the average profit 92,000 divided by initial investment 10 lakhs into 100. And the answer comes to 9.20%. And when you use the average investment, then in that case it is 92,000 divided by 5,40,000 multiplying with 100. This is the way we make the calculation of answer. And in this case the answer comes to 17.04%. Definitely you will be provided with the clarification and examination that which method is required to be followed by you, whether it is the initial investment or average investment. That kind of clarification would be provided to you. If at all such clarification is not given to you, you can use either of the method for the purpose of making calculation of answer, and you can just put a note for the same. That is the way you are required to make the calculation of the ARR. Now you may be wondering, that's over here, why sir initial investment plus scrap value is the average investment? The kind of argument that they have made is that say when you start the business, you make the investment of 10 lakhs. And whenever you are in the continuation of doing business, till that point of time, you are not able to realize the scrap value. So till the time the project is completed, till that point of time, the scrap value is also a kind of deemed investment that you have made in the business. so that 80,000 is added to the initial investment of 10 lakhs for the purpose of average investment calculation. This is what's the way ARR is calculated. Now the calculation part is over. How to take decision, that would be the next point. Now let us have a discussion about the decision making. The decision is supposed to be taken like this. Let's say we will be provided with a specific rate at which we want the return. Whatever the rate at which we want the return, that is going to be compared with the ARR. Suppose we want a return at the rate of 6% and actually we are getting a return more than 6, then in that case the project should be accepted. If it is provided that say we want a return at the rate of 20% and we are getting a return less than 20%, then in that case the project would be rejected. This is the way we are required to take the decision. So over here again there is an element of the subjectivity which is involved in the decision making. We understand that the kind of subjectivity that we had in case of the payback period and discounted payback period, wherein we would be provided with an information. Let's say this is the time period in which we want to recover the investment. And if at all the actual time period in which we are able to recover the investment is less, the project should be accepted. However, how do you determine that standard payback period? Do you have any base? No. So it is called that there is an element of the subjectivity which is involved. Same is the case which is applicable over here. Wherein, what is the rate at which you require the return? 6%, 20%. Do you have any base? No. That is the reason it is considered that there is an element of the subjectivity which is involved in the decision making. This is the way we make the computation of ARR, and we can obviously understand that say the concept of the time value of money is ignored over here. When you make average, then in that case of course that what is the time at which say you are able to say receive the cash flow, that is receive the profit, is ignored over here. Whether you are receiving the profit initially or whether your profit, that is you are receiving the higher amount of the profit initially or you are able to receive the lower amount of the profit initially, that point is completely ignored when you take the average. So over here the concept of the time value of money is ignored, and of course the profit is taken for the purpose of decision making, which is again considered to be manipulative. We understand that say as far as the financial management is concerned, it talks always about the cash flows. Why? Because the profit is considered to be manipulative, that is it can be easily manipulative. It is considered to be the like something misleading for the purpose of decision making. So that is also one of the ways based on which say this criteria is criticized. The only merit that it has is that it is very simple to calculate, otherwise it does not have any other merit. Chalo, heading right down ARR. In that write down working note number 1, calculation of average profit. Average profit will be found as total profit divided by number of years. The amount of the total profit is 4,60,000 divided by 5. That comes to rupees 92,000 per annum. Calculation of average investment. It is initial investment plus scrap value divided by 2. Initial investment is 10 lakhs. Scrap value 80,000 divided by 2. Rupees 5,40,000. ARR using average investment. It will be calculated as average profit divided by average investment. Average profit is 92,000 divided by average investment is 5,40,000 into 100 for getting answer in percentage now. 17.04. This is the way we can find answer. With paragraph write down, ARR can also be calculated using initial investment. It is average profit upon investment into 100. So 92,000 divided by 10 lakhs into 100, 9.20%. Write down a small note for the answer. First point, ARR can be calculated either using initial investment or using average investment. Second point, if clarification is not made about method, comma, we can do answer by either of the method and put a note for the same. Put a note for the same. Third point, for the purpose of decision making, comma, we have to compare ARR with a specific rate at which Management wants return. Full stop. If actual return is more, comma, except the project, and vice versa. Fourth point, ARR criteria has following limitations. A. It ignores concept of time value of money. B. It is based on profit, comma, instead of cash flow. There is an element of subjectivity in final decision making. Full stop. Minimum rate of return is determined arbitrarily. Full stop.